Welcome back. TransAlta is acquiring Far North Power Corporation for $95 million. The utilities company will expand its portfolio to include 4 natural gas-fired generation facilities in Ontario. Let's go to John Mould. He's equity research analyst, power and utilities at TD Cowen. John, thanks for joining us today.
Thank you very much for having me.
Do you see this as a good move for TransAlta?
Yeah, I mean, the short version of this is that it's an attractive price for these assets. They add further dispatchable capacity to TransAlta's fleet, but you want to be realistic about the scale of the transaction. It's relatively small compared to their overall asset base. So yes, we view it as a slight positive for the stock overall with that context around it.
Okay, where else does TransAlta have assets now? Will this be an easy acquisition for this company?
Sure. So just to give a bit of background on the company, it's a Canadian independent power producer. It's not a regulated utility. TransAlta has close to 9,000 megawatts of net generating capacity, and Alberta is its home market, but it's also got assets in other parts of Canada, the U.S., and Australia. Its single largest source of generating capacity is natural gas, but it also has a substantial wind fleet and are owners of most of Alberta's hydroelectric generating capacity. So in terms of ability to integrate, TransAlta has existing gas-fired facilities in other parts of Ontario, most notably in Sarnia. So that will give them the resources to manage the operational aspect of those facilities. And then Ontario does have a market price aspect to its power market, and TransAlta has a sophisticated energy marketing unit that it already utilizes to manage some of that output from its Sarnia facility, and should be very straightforward to integrate these facilities and their operations into its broader portfolio.
Okay, so what does the deal do for Hut 8 and Macquarie?
Yeah, so I don't cover them, so I'm not going to opine on how it affects them, but I can give you a little more context on how it affects TransAlta and its footprint. So why don't I talk about the assets for a second? They're mostly located in Northern Ontario, Iroquois Falls, Kapuskasing, and North Bay, and then there's a fourth one located in Kingston. They've all got something called a capacity contract, or known as a capacity contract, with the Independent Electricity System Operator, or IESO. That's the power market operator and main contracting entity for power in Ontario, and those contracts were secured under a competitive procurement for capacity from existing assets that was completed earlier this year. So these are important reliability providers for the system, particularly helping with reliability in Northern Ontario. As you've probably read, IESO anticipates electricity demand in Ontario will grow 75% by 2050. So it's important to have a diverse set of stable sources of supply, not just province-wide, but also regionally. And these assets are not a massive part of that, but an important part of that.
I was going to say, sorry to interrupt you, but how does it position TransAlta for the increased need for power, which many say will turn to natural gas?
So these facilities run at a relatively low, let's say, utilization or capacity factor is the buzz phrase in the industry. So in the shorter term, these are contracted. So about over 60% of their gross margin is going to come from those existing contracts, and the rest will be earned in the power market through the way TransAlta runs those assets, or manages them, I should say. Those have recontracting potential the next time IESO is seeking more firm supply in it's a medium term procurement that they hold. When that is occurring, is likely to be when additional nuclear units are being refurbished in the province. Nuclear forms the largest single source of power in Ontario and provides that firm baseload supply that the province uses. So the timing of these those contract expiries should be well matched from TransAlta's perspective in terms of the demand for recontracting with the nuclear part of the nuclear fleet going into refurbishments. So from TransAlta's perspective, this further diversifies their supply in the province and gives them a little bit more scale as a gas-fired generator in the province. They do own renewable assets in Ontario as well.
So it's a multi-year contract. You didn't mention sort of if it's a yearly that's up for negotiation, or is it multi-year that gets them further down the line?
Yeah, they're 5-odd-year contracts, so they run into 2031, I believe, is when they would expire next. So from a TransAlta investor or shareholder perspective, the way to think about those is that they provide a stable base. The capacity contracts provide a stable base of revenue for these assets. There's some additional revenues that get earned in the market, and contracts de-risk cash flow expectations relative to purely wholesale market power sales. So if you're a TransAlta shareholder, this adds some contracted capacity in Ontario.
John Mould, got to leave it there. Thanks for your time. Appreciate it. John is equity research analyst, power and utilities, TD Cowen.